My next guest says stocks could soon start to lose steam and is finding some opportunity among this year's laggards. Joining me now is Jimmy Chang. He's the Rockefeller Family Office CIO. It's good to see you, Jimmy. How are you?
Good. How are you, Scott?
I'm good, thanks. Losing steam? I mean, some people think there's still a lot to go here.
Well, I don't mean losing steam in the sense that there's a bear market around the corner. But given a strong run into the earnings season with expectations fairly high, and looking at a recent deceleration in the economic surprise, indices around the world, there are higher odds of a potential downward guidance revision going forward. So potentially we could run into a sideways market.
I can see why you would say that, but on the other side of it, of course, is the expectation of rate cuts. So how do I view everything that you just said, but knowing that the Fed's going to cut rates, and traditionally we say don't fight the Fed. Why should we fight it this time?
Yes, indeed. Historically, when the Fed starts easing, initially equities do well because there's expectation. On one hand, you argue for soft landing. On the other hand, you don't want to fight against the Fed, so equities indeed perform well. But I'm trying to take a longer-term view beyond the election. It's always difficult to call where the market would be in the next few weeks. But seasonally, once you get into September, early October timeframe, historically that's a more choppy period. Plus, given the political uncertainty and also what happens with the stimulus after the election, I will argue that the years 2020 through 24 have been supported by unusually strong, what I call a sugar high in both monetary and fiscal stimulus, especially on the liquidity front. And a lot of those will dry up probably by year end. So that sets up for a more challenging 2025. So while we're not turning bearish right now, I do want to do some rebalancing where appropriate.
Okay, to where?
I would say if you look broadly, about 50% of the index is tied to tech, communication services, and a couple of next 7 stocks in discretionary. That, to me, is too high for comfort on a long-term basis. At the same time, you look at sectors such as energy, less than 4% of the weight. Now, we're all excited about AI. You cannot run AI. You cannot run these data centers without energy. I do think natural gas is well positioned. So they are interesting opportunities in the rest of the market where valuations are still reasonable. We look at index level, it is elevated.
So you then are a deep believer in the broadening story over the next couple of years, I feel like it sounds.
Yeah, on a multi-year basis, you have to believe in the broadening out or you're really bearish, right? Because concentration means you're hiding in some of the secular growth names and you're implying that the rest of the market will not do well because of economic challenges. So in fact, when you buy into this broadening thesis on a multi-year basis, that's actually an optimistic view.
I mean, or you just want to maximize your gains in where the highest growth areas of the market are. It's not necessarily an indictment of other parts, but if you think that the best growth is going to come from the NVIDIAs of the world, assuming that their earnings can continue to deliver, wouldn't you just stay there?
Yeah, but it's not a one variable market, right? So you're talking about growth. At the same time, we're looking at expectations and valuations. So you can have very strong growth, but if it underperforms the expectations, then the valuations could potentially contract. These stocks will remain great companies, but valuations could contract. At the same time, in the rest of the market, where expectations may be low, and that's reflected in a more reasonable valuation range, that presents the opportunity should we get a broadening out, economic growth, around the world in the coming years.